What does it actually mean to build wealth that's fully yours? Not yours, but subject to whatever Congress decides. Not yours as long as tax rates stay the same. Not yours until required withdrawals force your hand. Because here's the uncomfortable truth. High income does not automatically give you financial control. You can earn $350,000, $400,000, even $500,000 a year and still quietly limit your future options. Not because you're undersaving, but because almost all of your wealth is sitting in one tax bucket. And when you build wealth without tax diversification, you're not just building assets, you're building dependency. In this video, I'll break down exactly how each tax bucket works. Taxable, pre-tax, and Roth. So you understand what you truly own and what you don't. Then we'll walk through a real side-by-side comparison of two $350,000 households over 20 years. Same income, same savings rate, very different outcomes. And finally, I'll show you how tax diversification gives you control in retirement. Control over your tax brackets, your withdrawal timing, and what your kids ultimately inherit. Before we talk about accounts, picture something simple. Think about the thermostat in your house. If it gets warm, you turn it down. If it gets cold, you turn it up. Small adjustments, smooth control. Now imagine instead of a thermostat, you've got 3 space heaters, all plugged into one outlet. You don't really have control anymore. You're overheating one room, freezing somewhere else, or blowing a breaker. That's what retirement looks like when all your wealth sits in one tax bucket. When everything is pre-tax, every dollar you pull out is ordinary income. And income stacks, withdrawals stack, Social Security stacks, investment income stacks. Suddenly, you're not choosing your tax bracket, you're reacting to it. Tax diversification is the thermostat. It doesn't change how much wealth you build, it changes how precisely you can control it. And control, not just growth, is what determines whether retirement feels calm or forced. Now, bucket number 1 is pre-tax. If you're earning $350,000 a year, maxing this out feels responsible. You get a deduction, your taxable income drops, you feel efficient, and you are. This is not a bad account. The problem isn't pre-tax. The problem is concentration. Here's how it works. You contribute before tax dollars. It grows tax-deferred. Every dollar withdrawn later is taxed as ordinary income. You put in the money, the IRS lets it grow. Later, the IRS takes their share at whatever rate exists then. You don't control that rate. The more you build here, the more future you depends on tax law cooperating. Now, I'm not saying avoid pre-tax. If you're getting a 6% employer match, take it. That's free money. But if this is the only bucket you're building, you're quietly reducing your future control. Now, let's talk about the only bucket immune to future tax rates. It's the Roth. And I know what you're thinking. I'm in a high tax bracket. Why would I pay taxes today? That's fair. Here's how it works. You contribute after tax dollars. It grows tax-free. Qualified withdrawals are tax-free. No required minimum distributions during your lifetime. Once money is in the Roth, the IRS is done with it. Roth isn't about winning this year's tax bracket. It's about buying certainty. In retirement, Roth income doesn't increase taxable income. It's silent income. And silent income creates precision. That's the thermostat coming back online. Bucket number 3, taxable brokerage. You invest with after-tax dollars. Dividends and interest are taxed annually. Capital gains are taxed only when realized. Long-term gains receive preferential rates. There's no age 59.5 rule, no required minimum distribution, no forced withdrawal. You decide when to sell, you decide when gains show up. In down markets, you can harvest losses, offset gains, reduce taxable income. This bucket equals flexibility, not because it avoids taxes, but because it lets you manage them. When you combine all 3 buckets, something shifts. You stop hoping tax rates cooperate. You start deciding around uncertainty. Now, let's put numbers to it. This is where we're going to run a model comparison of two hypothetical households. Picture two households. Both are 40 years old, earning $350,000 per year. Both plan to work until age 60. Both invest for 20 straight years. Both earn an average 8% return. Both receive a 6% employer match. Both invest an additional 10% into brokerage. Same income, same savings rate, same discipline. The only difference? Where their retirement contributions go. One funnels almost everything into pre-tax. The other builds intentionally across pre-tax, Roth, and brokerage. No difference in effort, just different bucket decisions. Now, household A, they go all pre-tax. They're contributing $23,000 in employee pre-tax contributions. $21,000 is their employer match. They contribute $35,000 into a brokerage account. After 20 years at 8%, their pre-tax balance is roughly $2.1 million. That means every dollar is taxed at future ordinary income rates. Tax deferred is not tax avoided. It's just postponed. Now, household B, they're tax diversified. Same contributions. However, they're putting $23,000 into Roth, $21,000 employer match, $35,000 into brokerage. After 20 years at 8%, their balances are as follows. The Roth account, roughly $1.1 million. The pre-tax account, roughly $1 million. Their brokerage account, roughly $1.6 million. Their total, again, is around $3.8 to $4 million. Similar total wealth, very different control. One has one primary income lane, the other has three. Now, the question comes up about tax savings along the way. Now, household A was able to deduct $23,000 per year from their income. At a 24% marginal rate, that's about $5,520 in annual tax savings. Over 20 years, that means they roughly deferred $110,000. Deferred, not eliminated. Now fast forward. If that pre-tax portfolio grows to around $2.2 million, and we assume even a 22% effective rate in retirement, that's roughly $484,000 in lifetime taxes. Nearly $500,000. Compare that to the $110,000 they deferred, that eventual tax bill is almost 4.5 times larger than the amount postponed. And that's assuming 22%. What if tax rates are higher in retirement? When all your wealth sits in pre-tax, you don't control that variable. You absorb it. The question isn't whether taxes will be owed, it's how much control you'll have when they are. Now let's back up and zoom out a little bit. Tax concentration doesn't just affect retirement income. It affects what happens after you're gone. Pre-tax accounts inherited by children must generally be drained within 10 years. 10 years. If they're in their own peak earning years, that income stacks on top of their own. Pre-tax accounts create ordinary income, which is compressed into a decade. Inherited Roth accounts, they're still withdrawn tax-free. Now, inherited taxable accounts, they receive a step-up in basis under current law. 3 tax buckets, 3 different outcomes. Tax concentration doesn't disappear when you do. It transfers. Now, here's what most high earners miss. All those advanced strategies you hear about, they only work if you actually have multiple buckets. What I'm talking about are like Roth conversions, backdoor Roth contributions, mega backdoor Roth, asset location, tax loss harvesting, and charitable bunching. Every one of those is a lever, but levers require optionality. Even if everything sits in pre-tax, there isn't much to pull. You're not strategizing, you're just reacting. Now, the biggest risk for high earners isn't missing some tax loophole. It's the predictable, expensive mistakes that happen when high income, equity comp, bonuses, and family life collide. I break down those in my next video. High income tax mistakes to avoid in 2026. No tricks, no gimmicks, Just the costly errors I see every year and how to avoid them using current law. Click right here and watch that next.